to fast forward then a little bit to the kind of third part of your book and the situation we were in, I think it was September of 2019.
Yeah.
With yeah, so essentially, I've heard a few people mention this to me, and sort of claim that we were on the precipice of like economic ruin in 2019, and I was like, how did I not hear about this? Like, how did I not know? So like, was that a reality? Like, is that where we were?
Yes. Isn't that crazy?
Mm-hmm.
When you read about this stuff, like I call it being Fed pilled. Like,
That's amazing.
yeah, I mean, in
Oh,
September,
I'm gonna title the episode that.
yeah, and it's like there's this group of people who watch this stuff, and you feel kind of crazy. But I mean, I walk through it in black and white, like in September of 2019, before a single case of COVID was not only recorded, but I think even existed. We had a we had the beginnings of a financial crisis in the United States. And I'll walk through it really quickly, but a really fascinating little time period exists between about 2016, 2017, 2019, which is this period where the Federal Reserve realizes, like, my gosh, we have got to stop doing this. We are pumping up asset prices to a dangerously high level. We might create price inflation. And the Fed was trying to pull back. It was trying to reverse these programs. But every time it did, the markets would basically short circuit and start to fall. Okay, quickly,
Why would that be the case? Just can you can you give like a basic explanation of that?
the basic explanation is if you spend several years patiently pumping up asset prices to an ultra high level, the minute you start to pull back, the markets react rationally and say, oh, well, this investment we made in a 0% interest rate environment is not going to make any sense in a 2% interest environment. I am taking my money out of that crazily risky asset, like, a fracking leveraged loan that doesn't make any sense. I'm going to, if interest rates are really climbing up to 2%, I'm going to take my money out of that risky thing and I'm going to move it into a safer thing. And part of that, I walk through this, but think about the 10-year treasury bond
Mm-hmm.
as sort of like a savings account for Wall Street. It's where you can stash your money in a really safe way. If that 10-year treasury bond is paying you 4%, well, that's not a bad return. You can stash your money really safely in a 4% 10-year treasury. What the Fed's been doing for a decade is making sure you don't have that savings account. They've been keeping those yields really low, so I can barely earn anything on a 10-year treasury. So I'm going to put my cash out into these riskier instruments like all the corporate leveraged loans. But when you raise interest rates, you change that equation. Those asset prices you've been patiently pumping up for 10 years are going to start to fall. And if you've been doing it very aggressively, those prices are going to fall far and fast. And so the Fed found itself in the position of every time it tried to pull back, the markets reacted and asset prices started to fall as they naturally would because they were stoked up through easy money in the first place.
Mm.
And this really culminated actually in late 2018 when the market finally took seriously the fact that the Fed was going to tighten. The markets went down. They didn't just go down, but they went down in this synchronized way where commodities, bonds, and stocks all fell at the same time, which was kind of not supposed to happen. And the Fed stopped tightening.
Mm.
And then the crisis of September 2019 was different in that the Fed was, we've talked about how they pumped all this cash into the Wall Street banking system.
Mm-hmm.
They were trying to take that cash back out. They'd been doing quantitative easing, and now they were trying to do something called quantitative tightening. And those cash levels on Wall Street began to steadily sink. And then they hit this level that created a panic. And the panic expressed itself in this overnight loan market that's kind of obscure called the repo loan market.
Is it the reverse repo market or is it the repo loan market?
It is the repo loan market.
Okay.
And this is where we start to need another hour. If we could please just like leave reverse repos over here for a second.
Yeah. Well, you're welcome, very welcome to come back on the show and talk about it again in the future, man. I'd love to have you back.
That'd be great, man. And we could do an episode on the repo market would be really interesting because the repo loan market is the lifeblood of Wall Street. It's supposed to be this very safe loan market where it's a fully collateralized loan where a investment bank gets the cash it needs for the day by loaning really safe treasury bills, and then they reverse it back and they get the treasury bills back and give the cash back.
Yes.
All we need to know for this discussion is that in September 2019, the repo market panics and freezes. The price of a repo loan, which is supposed to be an ultra safe loan, that price goes from 2% to 9% in like a day. Mm-hmm. Now, a 9% repo loan is a financial panic. And what's so interesting about this panic is I equate it to what we see in the age of global warming with like the quote sunny day flooding, where the sea levels rise and like in a coastal city, the town is flooding when there's no rainstorm. This was like that. There was a seizure and a panic in the repo market, but there was no like Lehman Brothers had not just collapsed or Russia had not just invaded Ukraine. The system was short-circuiting because the Fed was trying to withdraw its stimulus.
Is that the correct chart?
Overnight reverse repo agreements.
Is that different? Because because the GameStop community have been following the reverse repo market incredibly closely. They even have a high scoreboard because it looks like a retro game thing that because every month for the past 6-7 months, it went from being like the record overnight was like 200 billion or something like that, and then they just smashed through it. And this chart I don't even think is up to date because like it's frequently well over I think it's $1 trillion overnight, which is obscene. Like well over $1 trillion, like daily, and that's like 5 times as high as it used to be. And that could be a slightly different market. Maybe I'm not looking at the correct thing, but it's I'd say probably a similar indicator that the banks are in need of money.
Yes, and it's so crazy. A repo loan is where I give you treasury bills and you give me the cash equivalent, and that's a repo loan. And then the next day I take back my treasury bills and pay you back the cash.
Yes.
That's a repo loan. A reverse repo is the opposite. I borrow treasuries from you and give you the cash.
Okay.
And then we reverse it the next day.
Why would you need to do? I understand why they would need the cash. Why would they need to buy assets and give the cash to the Fed? Like what is the reason for that?
So this is a great question. First of all, if the Fed is offering enough money in the rate for a reverse repo, you take it, because the Fed is saying, hey, if you give me a bunch of cash, I'll give you this treasury bill, but the rate I'll pay you for doing this is going to be high. Like if you've got a bunch of cash sitting in your bank account, do a repo loan with me and you'll earn some money on that cash, and I'll offer you enough so that it becomes worth your while. Okay.
So the Fed needs money.
That's what it's
suggesting. No? Okay, maybe I'm wrong.
here's what it's suggesting. That crazy chart. Well, you should do a whole show that's just like insane Fed charts.
We could do that. We can make that the next one. We talk about the repo market and insane Fed charts. I'd do that.
We live in the era of insane Fed charts where it was one way until about 10 years ago, and then the spike is super high. You just showed the level of reverse repo loans. And what you saw was a spike in 2020 and then a spike that makes no sense like today, like in our current time.
Yeah, that one, like I said, that one that I've shown you isn't even as high as it goes. It's like twice the height of that the graph should be for where it's at now. It's mind blowing.
And it's a symptom of the truly mind-boggling, insane level of cash that the Fed is pushing into the banking system. It is pushing, like, okay, in 2010, when the book opens, the Fed did a quantitative easing worth $600 billion, and it was like this controversial thing, and it was a blah, blah, blah. Since COVID, the Fed has been doing quantitative easing at the tune of $140 billion a month. Like the permanent spigots are open.
Whoa, that is a
Yeah,
lot, man.
it's a lot. It's hard to get across how much money the Fed is pumping in. So all this cash is flooding into the banking system, and there's so much that the banks literally have too much, and they're storing some of it back at the Fed through this reverse repo. That's why you're seeing this crazy spike. Is the reverse repo is the Fed taking cash back into its house through this weird loan program. So yeah, it's just a function of how much cash is out there that it just doesn't even make any sense. And it just highlights where we are right now in 2022, whereby
Yeah, where are we? Like, how screwed are we? Like, is there a chance that this doesn't like all fall apart? Thanks for making it all the way to the end of the video. Don't forget to like, share, subscribe, and leave a comment for us in the comments below. Let me know what you thought and if you'd like to see more of this from the show. Thank you, and we'll see you again next time.